Have you ever wondered why you can be a safe driver for years and still watch your car insurance go up? No accidents, no tickets, no claims, yet every renewal somehow feels more expensive than the last. Most people assume insurance works in a simple way: drive safely, pay less, and take risks. Pay more. That sounds logical, but that isn't actually how insurance works. To understand why, we first have to understand what car insurance really is. At its core, insurance isn't protection and it isn't a reward system. It's a shared money pool where everyone pays in, claims are paid out, and the pool must always stay solvent. If more money leaves the pool than enters it, the system collapses, so everything about insurance is designed to prevent that from happening. Originally, insurance was meant to spread risk across a group, so one person's bad day didn't financially destroy them. Over time, though, the system grew larger, more complex, and far more expensive, which changed how pricing works. Today, you are not priced as an individual driver, you are priced as part of a risk group. That single detail explains most of the frustration people feel about insurance. Let's look at a real-world example. Imagine two drivers with the same clean record, the same habits, and no accident history, but one lives in a quiet rural town while the other lives in a busy city. Even though they drive the same way, the city driver pays more because insurance prices environmental risk, not personal intent. More traffic, more accidents, more theft, and more lawsuits all raise costs for the entire pool, even if an individual driver never causes a problem. The driver didn't change, the environment did. Now consider another example. Two people live in the same area, have identical driving records, and differ only in the cars they drive, with one owning an older sedan and the other driving a brand new SUV filled with cameras and sensors. If both get into a minor accident, the older car might cost around $1,200 to repair, while the newer vehicle can easily cost $6,000 to $9,000 for the same damage. That difference isn't about driver behavior, it's about technology, calibration, and expensive components that dramatically increase claim costs. Insurance prices outcomes, not intentions, which is why older cars are often cheaper to insure even if they lack modern safety features. This leads to an interesting question. Cars are getting safer, with more driver assist technology than ever before, so why does insurance keep getting more expensive? The answer is simple. When accidents happen, they cost far more than they used to, so even fewer crashes can still raise overall expenses. Lower frequency doesn't always mean lower cost. Medical payouts also play a major role in rising premiums, as emergency care, physical therapy, long-term injury claims, and legal settlements continue to increase year after year. Even if you never get injured and never file a claim, those rising medical costs are still built into what you pay. Fraud adds another layer, with staged accidents, exaggerated injuries, and inflated repair estimates being factored into everyone's premium whether they participate or not. That's the nature of risk pooling. Costs created by a few are absorbed by the many. Now consider this. Car insurance isn't optional, it's mandatory, which means participation in the system isn't a choice. When something is required by law, the system is designed for stability and survival, not personal fairness. That doesn't automatically make it wrong, but it does explain why responsibility isn't rewarded the way people expect. If insurance were purely about responsibility, your rate wouldn't rise when your behavior stays the same, your zip code wouldn't matter more than your driving, and technology designed to improve safety wouldn't increase costs for everyone. These aren't emotional complaints. They're structural questions about how the system is built. The insurance system works exactly as designed. It spreads risk, absorbs cost, and protects itself first. Whether that design still fits modern reality is the question most people are never encouraged to ask. A system created decades ago now operates in a world of expensive technology, rising medical costs, mandatory participation, and limited transparency. No one explains this, they just send the bill. Once you understand how insurance actually works, the question shifts from frustration to logic. Does this system still make sense the way it's structured today? Who made these rules? And who benefits from them staying exactly the same? Really makes you think.